Welcome back to our podcast. Last week, we discussed a very interesting topic on withholding VAT. And two colleagues, Crispin Daka, CD, and Jafet Tembo, discussed the topic extensively. Today, we are back, which is financing for businesses. Businesses do finance their operations using different instruments. Others have got ready cash to manage and sustain their operations. Others use different instruments to sustain their operations and manage their operations. Today, we zone in on one particular instrument that the businesses use to finance their operations, and that is the issue of loans. Now, just by mentioning loans, people are already catching feelings. Businesses are already catching feelings. And I am with my usual guest, Crispin Daka, to discuss this subject. Sidi, how have you been?
I've been excellent. Thank you. So good to be here. Always looking forward to these conversations.
Excellent. And as usual, great feedback coming from the individuals and companies that are following us. And some of these topics we discuss here, they affect the business directly. And that is why we have this podcast to act as a knowledge source, but as well to also act as a source where businesses and other corporates can contact us for possible assistance where they do have pain points. Let's get straight into it, CD, and start from the top. What is a loan?
Oh yeah. Obviously, in terms of a loan, and we're really going to focus on bank loans, especially in the market that we are in, is the most predominant available source of credit. So this is where you are effectively using other people's money to grow your asset or your wealth to use. I mean, in fact, the issue is you're using other people's money to use it for whatever it is you intend to, and then you need to pay, but you have an obligation to pay it back with interest. So at the end of the day, in terms of the loans as they stand now, and most of them they can come in different formats. In terms of term loans, meaning it has a fixed period within which you need to repay, which would be it could be a year, 2, 3. I've seen even some of them now in this market, even going up to 5 years. So that's a term loan because it's based on terms. And then you can have other things, like an overdraft, which is more or less like a revolving fund, more like which are usually annual because they are renewable on an annual basis. So they give you credit up to a certain limit, and you can do with it whatever you want, but you cannot go beyond the limit. And then you recycle the money, goes through it, and you create some space. Then you can as well continue using it. So you've got very short term as well as medium term to long term kind of loans. And with the banks now, and the thing with the issue of loans is this is not just for business, though we are focusing really here on business, but what we are discussing and the tactics and the thinking applies even to personal loans.
Exactly.
So the thinking doesn't change. It's just that it has to be looked at pretty much the same way. The key message, though, that we want to deal with is the issue of, are loans good or bad?
Oh, bad.
Okay,
I think
because that is a very, very, very emotional discussion. And then we'll go into the detail how we understand this and how we have seen others actually leverage the issue of loans, so that we can
That's
answer that question: are loans good or are they bad? And yeah, that's
let's
sort of it.
let's
And
let's
so that then we can share finally a scenario where I know the Bible says the borrower is a slave to the lender. But there is a way in which you can flip that, where the bank
become the king.
becomes, you become the king, and the bank becomes your
Slave.
there is a way in which, using the rules of the game, if you play it nicely, and if you play it, it's a long game. If you play
Smartly.
it, up to a certain point, you can actually have the bank work for you and not you working for the bank,
To the bank.
which is because the rules are pretty much designed such that, because like, the way I see it is that loans were created for owners and not employees. So, and that's the mindset shift that we are going to talk about, in terms of how does an owner think, and how does sort of an employee mindset, and how do those interplay to make sure that you turn the tables. You turn the tables so that you don't work for the bank. The bank
No,
works
let's
for
let's
you.
get exactly. Let's get this one out of the way.
Yeah,
A lot of people out there, even those that are watching us, will say loans are bad. That's word
yeah,
on the street. Loans are bad.
yeah.
Just put some clarity to that notion. And most of us grew up thinking borrowing is bad.
Mm,
Just shed
yeah,
some light on why people think like that and what the correct position is. Are loans bad? Are loans
yeah.
good? At what point do they become bad? At what point do they become good?
Yes, yes, yes. So I don't think either of the position is wrong, because everything is always rooted in experience. So if somebody has witnessed, or they have gone through a bad experience with bank loans, then their emotion is going to be loans are bad. Where
Bad, yeah.
people, we are always sort of cultured by what we go through, what we experience, or what we see other people experience. And it's the same thing on the other side as well. If you've seen somebody really leverage loans, and achieve success, great success, you might be thinking, oh no, actually, the loans are good. So for me, the way I see it, so I don't judge the positions that people take, but my view is that we need to understand. My view is it's in the middle of the road, and where I think that bank loans to me are neutral. They are neutral. So meaning, just like fire, we can use fire to heat and cook food, and the nosh and the chow,
Throw us
or
some goat meat, yeah.
it can actually burn us. It's depending on how we.
The
So is
usage,
fire good or
application.
bad? The issue is, it depends on your knowledge, your skill, in terms of how you manage or deal with fire. So that's how I see the issue of bank loans as well. I see them as neutral. But if you are going to, so they just amplify where you are. So they are going to either work for you, or you are going to work for them. There's no
Excellent.
middle of the road. So you now need to develop that skill of managing the issue of the loans. Maybe, I don't know. I can probably just give you a bit of how I've appreciated the emotions that go, because at the end of the day, money is an emotional thing. They even say money is a spirit, and the bank loan is money.
Yeah.
Yeah. So there are two schools of thought or emotions that come with bank loans. The first one, so there are two polar extremes. There is fear of debt, meaning bank loans are bad,
Yes.
and because that's very legitimate. There will probably even be examples of how people have lost their fortunes. They've been destitute, all because of a
Yeah.
bank loan, because the bank came and grabbed everything and things like that. On the other side, I call it greed, which is overconfidence. So you go to the other extreme where you now just go into over borrowing and to fuel. Both of these are not realistic in terms of how life is, because the fear is based on pessimism, right?
Yeah.
That bad things are going to happen and they're going to happen consistently. uh, the grid on the other side is also where you are betting on the upside, thinking
Yeah.
that things will always be great and there'll be no downside. And yet we all know that life is like all the
Never a
seasons,
straight line.
right? So
Yeah.
even in the economic space where the money is, like in the money space, because we can call it the money supply and demand, which is effectively the economy, there is also seasons, right?
Yeah.
So we have a season of expansion,
Yeah.
meaning money from the banks and everywhere else, like we're having now, exchange rates stabilized and forever improving. Interest rates sort of have a downward trend. The MPR has been very stable, and in fact, even some of it even reducing a bit. Inflation, we are in single digit inflation, you
Yeah.
know, for a long, like we haven't been for such a long time. Now we are back into single digit inflation. So you have that as expansion. It's a season. So you have expansion, you have, decline, and
Yeah.
usually they even follow each other. I mean, you have expansion, and then it doesn't just expand and expand forever. It will reach a
You take
peak.
a dip.
So they
Yeah.
say expansion, then you have a peak season, then you have a decline,
Yeah.
then you have a recovery. Again, you have an expansion. So you can see that if now the two feelings of fear and greed are on the extremes. This
Yeah.
one is looking on the downside, the other one is looking on the upside. But we
Upside.
need
Yeah.
to be in the middle of the road.
Yeah.
And
Yeah.
that's what we call leverage. So that you need to be leveraged. So you need to have a combination of loans. Yeah. So you don't need to fear, you don't need to be overconfident, you just need to be confident.
So excellent. Excellent. What are some of the attributes that people accessing loans need to have? What a typical borrower, what sort of profile is that should that borrower have in order for them to be in the middle, to occupy the middle ground that you spoke about, not on the high side, optimistic side, not on the pessimistic side, but occupying the middle ground? What sort of profile should that person or organization borrowing or accessing a loan facility from the bank need to possess?
Yeah. So for me, I think it starts with mindset, which is much more the intention for borrowing. So there are effectively, you would say, two types of borrowers, right?
Yeah.
There are people who borrow to finance a lifestyle, and there are
Take a
people
trip
who
to Dubai.
borrow to buy assets and build wealth. Yeah.
Correct. Yeah.
So those are the two. So that's one of the, for me, that's a very fundamental starting point. What's the kind of intention and mindset we have? Because the one on consumption is thinking, oh, I need a $50,000 motor vehicle today,
Yeah.
and it only costs $700 per month in loan repayment, I can afford that. And they go and get it because they want it. They want it and they want it today.
Yeah.
So that is what we call financing consumption. Okay. Then on the other side, we have, oh, $700. What kind of an asset can I invest into whereby if I was to pay I can earn a decent return?
Yeah.
And if I were to earn a decent return,
Above the
I can
repayment
pay
threshold.
off, I can afford to pay $700
Monthly.
monthly and even remain with something. Yeah, that's a different. So for me, that's the first thing that that has to be. Though the bank doesn't care, because the bank, in terms of how they assess them, they assess your risk, your ability to pay,
To repay. Yeah.
to repay. So they won't care whether you want to borrow for consumption or you want to borrow to buy an asset. They don't care. All they will do is to say, can this person afford to make,
pay.
yeah, and can they even provide us with appropriate security should they fail to pay? Yeah. So that's what the bank would do. But the two kind of profiles when using the debt will end up in very different scenarios over time. And this is where now it's an issue of time, right? So there's the issue of, they say, compounding can be, like compound interest, can be your friend or it can be your enemy. Yeah. It can be your friend or it can be your worst enemy. It can be your best friend or it can be your worst enemy. It depends on where you are. So if you go onto the consumption side, meaning now you are working for the bank, then it is going to be your, and over time. So compounding also goes with the issue of time. So right now, it might feel like you are both at the same place, right? But when we project that 5 years from now, you discover that the one who went for consumption has not built any capacity at all. The one who went for putting the money into an asset which generates money, who have, and at the end of that 5, they will have an asset that they own. So you can see that in terms of wealth, this one has depleted. They effectively, they have wasted their 5 years. The other one has utilized the 5 years, and this is where the whole thing comes through in terms of debt. So that's one of the, for me, the major, before we even go into the next attributes that somebody needs to have, it's an issue of what's your intention, what's your mindset. Your mindset should not be, I want this, how, therefore I can afford the repayments. It has to be, what asset can I buy to make sure that, that asset can afford, not I can afford from my money. No, my earnings should go somewhere, but what asset can I buy which can afford to pay those things? Then for me, that's the one becomes a good borrower, the other one is a bad borrower. This one, we even know that they'll work for the bank loan, they'll work for the bank pretty much for the rest of their lives. But this other one, they will rule the bank. At some point, they will grow to such a level that the bank will worship them. And money now even goes more to them. The banks will even go to them now. Do you want something? Have you seen the way the bank, when they see your account is fat, the way they throw you a lot of things? Like we even have this loan here. You have this loan. That's pretty much my view on that one. and I think we'll probably get into more detail from there.
Excellent. So in terms of whilst we're talking about the profile of a person accessing a loan, there are some people who fear they can never get to the bank. What drives the fear? Why do people fear loans? I mean, I grew up a long time ago hearing of how the miners used to sell chickens, and they used to get a loan to get those chickens. And even the name of those chickens, now we call them in our typical language, kukuzalon. But that's where it comes from.
Yeah.
Meaning our our folks then never used to fear loans. They would actually invest in chicken business using a loan, and they would reap the rewards from that. Now, why do people now fear loans? What drives that fear?
Yeah. For me, it's the issue of knowledge and not, lacking the confidence that they'll be able to manage that loan. Yeah. And of course, it would be an issue of they sort of have had these experiences. And the whole process actually is not a very straightforward process, because the bank has got, it's using other people's money. So the bank, it's not like this is the bank's money. No, this is money which has come in as deposits. So it's other people's money. So what the bank needs to do before they can give you any money, they want to make sure that you are a safe bet for you to pay them back. So there is a lot of process that you have to go through, and a lot of commitments based on how you've been maintaining your things like credit history, and all that stuff, which will determine your risk profile from the bank's point of view. So there's quite a lot of things that they require to show them that you are capable of managing that loan. Yeah. So that process for me is very daunting to a lot of people. So taking aside the issue of will I be able to repay this loan, most people don't even know, because they've not gone down to do an analysis to understand what the impact like you cannot even understand what
Yeah,
the impact of the loan will have
on their
for
life.
whatever it is that they want to do. Yeah.
Yeah,
And here in this case, we're really talking about trying to focus on
business.
business loans, right?
Yeah,
So there's been no assessment. And some of them actually, the only time they really go and get a loan, it's because they've got no other choice. They've got an order, and they can't even, they're only just obsessed to make sure that they deliver on the order, but they didn't prepare. They didn't prepare to go and borrow in a very, very effective way. So you find that that's what causes the issue of one, the fear is that, and which then leads for them to borrow on an emergency basis with no analysis. They don't even understand what's the impact that this loan is going to have on my business. Yeah? I'll give you an example. You need to know the impact of the repayments. Yeah. So when you go for a loan, it has a cash flow that the bank is going to give you, that you need to be paying this much per month or per
every
quarter
month.
or
Yeah,
whatever the arrangement is. You need to know how that now relates with the income, the cash that you'll be coming to finance that. Because if you don't know, then you run a risk that you fail to meet some of those. Yeah. And usually the planning there has to be such that you look at planning for it on the downside, like worst case scenario. If this was to happen, what would I do? You know, if I was to have no cash flow, or maybe a drop in my cash flow for 3 months, what can I do? Do you have a 3 months cash cover that can deal with that as you recover, so that you keep current whilst continuing? Because defaulting on a loan is actually very, very expensive. Yeah, it can even lead to, and a prolonged default might even lead to you losing. Usually most of these are
Your
secured,
credit
you losing your property. You
goes
need
down.
to know what is the spread. Yeah, the spread pretty much is, this is the interest I'm paying. What is the return or the yield, the margin that I'm getting, and how does that compare? Because you need to have a bigger spread, right? So that you are able to afford other costs as well as the interest. Yeah. So profitability, you need to know how profitable you are. You know, reinvestment of what you are, reinvestment of your, so that's what we call increasing your equity. Is that instead of, they say, poor borrowers consume profits,
Yeah.
but good borrowers reinvest profits. Because if you reinvest the profit, your return now is, if your spread actually increases, because on your money, it's your money. So, and you only leave that for the bank. So then you can pretty much, leverage the bank to even achieve even bigger opportunities. So those are some of the things. So effectively now it comes down to, do you know the numbers? So the fear comes from, will I be able to afford this? Yeah.
So,
And so knowing, developing the skill, or getting somebody on your side who
to
can
do it for
help
you.
you navigate through these numbers and explain what the impact would be. Yeah. Because even before you take debt, the other thing we have learned is that, for instance, you should never exhaust the whole extent of the facility you are entitled to. No, always go in with an equity component, meaning your own money first, and then, yes, your own money could be smaller, but let it be smaller
Part of
than
them.
the bank in everything else. Like even in our personal projects, that's been the issue. At least go to 20-30% your own money. Then if you have an overdraft, don't ever run it on hardcore. That's the most, hardcore means you are
To
always,
the
say you
full
have a
limit,
1 million kwacha
maximum limit.
overdraft, and it's always at 1 million,
Oh,
then it's
nine
the
nine nine
most
nine.
expensive. Yeah, it's the
Exactly. Yeah.
most expensive kind of facility. In fact, even the bank would not be very happy with you. Yeah. If you're always hardcore, like you just create a space of 200 and 200, space of 300, the 300 also goes out, then it means you're not using it. They want it to go to 1 million, come down to, or probably not zero, but at least come down substantially down, maybe to 200, and then it goes up. Then that way they know that this is a healthy kind of arrangement. So
Exactly.
all those scenarios, yeah, they need to be planned for before you actually get the debt. You say, look, let's plan for the worst case scenario. In this case, if our revenue dropped by 20%, what would be the impact of the loan? What would be our affordability? If our expenses went up by 10% or whatever it is, what would be our um, the impact on the issue of the loan. Yeah, understanding the difference between cash flow and profitability. Because, you know, RK, you can be profitable, but illiquid.
Don't have cash. Yeah.
Yeah. So I can give you an example. You go and sell to a mine or whoever on credit. In these days, it's say, I mean, this is on record. I would say KCM, for instance. You sell to them, and they
You pay
decide
after
to only,
some
or
weeks,
maybe
some
even,
months.
let's put it this way: you go and sell to government a big contract on credit. Of course, it can never be on cash, right?
Yes.
But they only pay you after 1 year. And in on that sale, you actually
You have
put in
made
maybe
profit.
even a 50% margin.
Yeah.
Yeah. So you have 50%, so you're profitable. You have 50% profitability. But in terms of cash, you don't have. That's why they say profit is for the future, but cash flow is for
Cash.
today. If you need to survive today, it's the issue of cash flow. So, and
Cash
even
is
for the
king.
loan, it's the same thing. You need to model the cash and create buffers. You know, like we love the issue of 3 months of operating costs, cash cover, up to 6 months operating, where you have even included your loan repayment amount. Yeah, you have it as a reserve, meaning that you can go for, if you have serious cash flow crunch, you can go up to 6 months. You won't default on your loan. So
Obligations.
all those things have to be planned. And if you go with it to a loan thinking like that, for me, you go there with very confident, with a very good confidence, and you can build up even very good credit history with the banks, which is what they want. Because if you have, and that's the other thing I wanted to say about the people who fear debt, is that if you don't have a credit history, meaning you cannot show anywhere that you borrowed and you
And you're able
repaid,
to repay.
the time when you need the loan, nobody will
No
give
one
it to you.
will show up for you because
Yes.
they're not
No
sure.
one will show up for you. They say, even if I knew if. You've
They're
never.
taking a big risk to give
And
you
you're
money.
taking a big risk. But if they can see that
You borrowed and
you've
repaid.
borrowed before, you've serviced it, you've done what, all these issues, then they are good. Yeah. Um, so all those, they come from the issue of preparation and having that knowledge. And we know that most of the growing businesses, they don't need to have all this information, but at least you need to seek somebody on your corner. It's worth the value to have somebody on your corner to give you advice in terms of, what, this is what we can do. I can give you an example, like it happened a few years ago for one of my clients. When, like we were in expansion times, they call it, the boom time at the time. And that's when most of these chains were coming into
The market. Yeah.
into the country. Um, and they went and gave a very big contract, contract opportunity for the supply into some of these chains. And as a result, uh, this business was moving from just being purely cash to now being where they are now introducing credit. Yeah. And then they went and borrowed from the bank. They were given proper facilities for equipment, for based on this same contract, for equipment, for um, working capital, and some of it even went towards construction of a factory, because then it meant that to satisfy this order, they needed a factory to do that. So it went, my belief, and by the time we were meeting them, they had not yet done the preparation to see the impact of how much should they bring in to make sure that they leverage the debt instead of choking the business. So they went, and it, from what I could see, it was very much almost all of it debt financed. So they got that, and then got from different banks. Now, when it came to execution, in the beginning, it was a bit of sort of okay because the business was okay and everything else. Then down the line, people changed in this place. That contract was cancelled, and you still have these liabilities. So there was no scenario analysis of what would be the impact if we lost our key customer on this. Yeah. So it might have been a situation of whether maybe let's delay this growth until we can afford from our own resources up to this level. Maybe only this level is what we can achieve. So for me, that's the thing that really causes, one, the fear, and then it's because they are not confident. The preparation is what is the problem. And that's where it's important to have preparation before actually engaging in.
Excellent. Obviously, well put and articulated. Now there is a process that, as individuals, even as organizations, we need to undertake before we even borrow. You need to do a self-assessment. You need to assess yourself. Can you borrow? What does it take to borrow? Now, take us through some things that a business needs to have in order to access a loan facility with the bank. And are there tools out there that we can help the business to do a quick assessment so that they know, even before they take an application to the bank, they know that they are bankable. They have got a good case to approach the bank to borrow. Just delve into that, because that is critical before you even start thinking about borrowing. Do you have what it takes to borrow? Do you have the necessary information or documentation, or can you fulfill the process that the bank requires of you? Maybe take us through that process. And are there tools available? Can we help the business with tools?
Yeah, no, I'm glad. I thought you'd never ask. Yeah, no, we've been working very hard because we realized actually, especially with the advent of the SI, okay, it's been really now accelerated with the advent of the SI 68. The fact that to execute on that opportunity, you need to leverage the banks. So we've been working very, very hard on making sure that we support the market with bankability tools. Yeah. So let me tell you a typical example. The typical example of a current borrower, business borrower, especially in the growing business space, so-called SME, is that they want to borrow, so they go to the bank, then they're given a list. This is what you need, blah, 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 blah. They put things together, they send it, then there's, oh no, we also need this, come back. So the process, the turnaround time between them applying for a loan and them actually getting a decision from the bank, whether it's a yes or a no, is very, very long. I've been on some deals where we've been going on for 3-4 months back and forth with the bank. But opportunity doesn't work like that.
Wait, yeah.
Opportunity doesn't work like that. Yeah. I mean, other than the most ridiculously expensive, Shylock dates, which they give within 24 hours. But we know that those are predatory. They are not sustainable in a business. The ones that are sustainable is the one that you get from a properly, bank which has a long-term view of your relationship, other than the Shylock arrangement. So you find that the turnaround is elongated. And this is not a fault of the bank. like we said, the bank, they're holding money on behalf of somebody else.
Depositors,
So
yeah.
they need to go through all their risk processes to make sure that, for instance, they want to know all your know your customer documentation is in place, residence and things like that and all that stuff. They want to, the other thing is they want to know your turnover, right? Because that gives them an idea of where you fit in on their affordability ladder, all right? They want to know what your, what kind of other loans you have, okay? Do you have any other loans? They want to know quite a lot of these issues to do with compliance, your tax clearance position. They want to know all these issues so that they are all in place, so that then they can process and quickly assess you. But you find that this process is, usually takes quite long, but with preparation, this can really crash this time to where you don't lose the opportunity, because some of the people have had clients who just gave up on a loan and said, you know what, let me just find another way, because by the time I'm given this money, this opportunity will be gone, because opportunities are not going to stay there forever, right? So that's why at Moa Zambia CFS, we've come up with a free tool because we want to help the market with it. So it's a free tool where we've picked what are the standard mandatory and general information that you need. And it's just a yes or no. Within 5 minutes, you are able to get your position. It's your yes or no. So it will say, do you have audited accounts or management accounts for the last 2 or 3 years? So it has all the mandatory questions, which are standard across the board. Yeah. So it doesn't matter which financier you are dealing with. This is the kind of information at the very minimum they'll be asking for. It won't be anything beyond this, other than in specific circumstances. So we've then created an online tool where you can just go in within 5 minutes, answer yes, no, yes, no, yes, no. It will give you a score and assessment and a report where it gives you your level of bankability. Are you bankable now, or are you bankable? And we can fix, and it even gives you an idea of what you can fix, or you are fully bankable. And please, like, have a shot at this. You are ready to go and approach. So we will just encourage a lot of people that even when you don't want to borrow, like right now, it would be nice to go through the tool. We'll put the link as part of this, to go through the tool and just know where you stand. Yeah, so that if there are any gaps, you can have a plan now. And for any of those, because we offer actually this service of preparation for all sizes of, we can talk and then assess and see how we can help in preparation. So where we effectively handhold the whole process, including discussing with the bank, giving them whatever they want, and producing whatever information may be missing. So that when we present, we are not guaranteeing that they'll give you a bank loan, but at least you have a very good chance of, one, getting a response in the quickest possible time, and you have a very good chance of actually getting it, because we've had engagements with the most of these banks, and we've incorporated most of their risk assessment and whatever they need. We've anticipated and put them into our process. So with that process, yeah, we can do the hand holding. So we can do in the credit preparation. We can even help all the way to those that are ready to whatever, and they need us to support them with the downstream documentation like business plans, cash flow forecasts, and so forth and so on, for us to do that. So we take the responsibility away. We fill in everything, we confirm, they just sign. Even on the application, the client just signs. We submit for them. We go with them and negotiate and things like that.
Excellent. Excellent. Well put, well spoken. And I'm sure the people listening that have got some kind of working capital trap, they have no money, they are waiting to be paid money. They now know that you can borrow, you can access the facility, loan facility from the bank. Borrowing, as you put it, is not bad. But you need to have a good plan to utilize the money. Don't borrow for consumption. Borrow to reinvest in the business. Don't eat the profits. Reinvest the profits. I think keywords, CD, what are your parting shots? As we conclude this topic on loans, I know we are going to discuss a number of other instruments, but I thought it was important that today we zone in on the loans. What are your parting shots?
Yeah, no, my parting shots is, I'm very passionate about this because ours is to unlock the potential, and leveraging loans is the only way you can crash the time, if done responsibly, loans can be, the fuel that can actually catapult the business to growth. So we are very passionate and we're doing everything we can. And like you said, it's an issue of preparation. If you are prepared enough, then you shouldn't worry about, whether the loan is good or bad, because in the preparation, that's where you have all these questions where you ask yourself, and make sure that even all your emotions are managed. And in the future ones, we'll now get into the detail of exactly, from the number side, what numbers should you be looking out for, from the bank side, and then even from the bank relationship side. How do you grow the relationship to where the bank is a partner to your growth? Yeah, so where they value you and you reach a point where you are a valuable, yeah. And for me, I think the graduation is, you start small, but the journey must be, you borrow because you want to, not because you have to.
Have to.
Yeah, yeah.
Excellent.
Where you borrow because you want to.
You want to, not because you have to.
Yeah, and we even talk about the issues of refinancing and down the line.
Exactly. There's so much to talk about. Very exciting. I know this is close to a number of businesses, but we are here to give you information. We are here to help you. We are here to partner with you. So get glued to this podcast. We have a lot to talk about in the next podcast. All you can do is to obviously look out for the next podcast. CD, as usual, been awesome. Nice one.
Amazing.
Excellent.
Over and out.
Excellent. Let's not forget that too. That too is important.
Indeed. Yeah.
Excellent. Thanks, CD. Until next time. Bye for
Until
now.
next time. Over and out.
Thank you, man. Cheers.
Cheers.